Digital Assets for Investors. Chapter 10, Crypto Investing Frameworks. Section 1, Fundamental Analysis. Fundamental analysis starts by asking a different question from most market commentary. Instead of asking why price moved today, it asks what this asset might be worth if the underlying project actually succeeds. That shifts your attention away from hype, momentum, and social media excitement and toward the sources of durable value. You begin looking at whether the project solves a real problem, whether people are likely to use it, and whether the token is positioned to benefit from that usage. This is especially helpful for longer-term investing, because short-term prices can swing wildly without saying much about quality. At the same time, strong fundamentals do not guarantee quick gains, so this framework is about improving judgment, not predicting the next move. In crypto, the core idea is familiar, but the evidence looks different from what you would study in a stock. You still care about whether the project solves a meaningful problem, but you also have to ask whether blockchain is actually necessary for that solution. Technology matters more directly here, because many projects are valued partly on the plausibility of their design and ability to scale. Team quality also carries extra weight, since early-stage execution risk is often very high. Then you add tokenomics and network health, which are unusual compared with traditional investing but central in crypto because supply, incentives, and usage all affect outcomes. Finally, you place the project in its market context by asking how large the opportunity is and how strong the competition may be. A helpful way to stay organized is to separate fundamentals into 3 levels: project, network, and market. At the project level, you study the purpose, the roadmap, the team, and the role the token plays in the system. At the network level, you want evidence that the system is alive and functioning, including user activity, developer work, security, and validator or miner participation. At the market level, you zoom out to demand, competitors, regulation, and the broader pace of adoption. Each level answers a different question. Is the idea credible? Is the network actually being used? And can it win or survive in the market? Strong analysis connects all 3, because a good concept without usage, or good usage without a viable token design, may still lead to a weak investment. A disciplined review usually follows a sequence rather than jumping between random metrics. Start with the project's own claims by reading the white paper and roadmap, because that tells you what the team says it is building and how it expects to get there. Then examine the people behind it, including founders, advisors, and any evidence that they have shipped real products before. After that, analyze tokenomics to understand supply, incentives, vesting, and how value might flow to token holders. Once the structure makes sense, turn to network activity to see whether real usage supports the story. From there, compare the project with competitors and finally estimate a reasonable valuation range. The overall goal is to move from narrative to evidence to a judgment about whether the market price seems sensible. The white paper and roadmap are your first reality check. A serious project should explain in plain terms what problem it is solving, why a blockchain is needed, and how the system works at a high level. If you cannot explain the project simply after reading its materials, that may be a warning sign rather than a sign of sophistication. The roadmap should also contain milestones that are concrete and time-bound, not vague promises about revolutionizing an industry someday. For example, testnet launch, audit completion, or mainnet release are better than broad claims about future dominance. This is also where buzzwords and extreme claims tend to appear. So it helps to separate ambitious vision from evidence-based execution. In early-stage crypto, people and token design can matter as much as the product idea itself. A strong team usually shows verifiable experience, prior delivery, and a willingness to operate publicly and be accountable. Anonymous teams are not automatically bad, but they require much stronger outside evidence because trust has to come from execution rather than reputation. On the token side, you want to understand total supply, inflation, vesting schedules, and whether insiders have large unlocks coming. You also need to ask a basic but important question. Does this token actually need to exist, or is it loosely attached to the project? A useful protocol can still be a weak token investment if dilution is heavy, or if insiders can sell large amounts into the market. Once the project and token structure look plausible, The key question becomes whether the network shows real traction. Transactions and active addresses can help, but they matter more as trends over time than as isolated spikes. Developer activity is another important signal, because active code updates suggest the project is still being maintained and improved. Depending on the type of network, you might also examine total value locked, staking participation, validator count, or hash rate to judge economic support and security. Reliability matters too, so uptime, audit history, and past incidents deserve attention. No single metric is enough on its own, which is why strong analysis looks for a consistent pattern across usage, maintenance, and resilience. Valuation in crypto is difficult because many tokens do not give holders a direct claim on profits. If a token has cash flow-like features, such as fee sharing, staking rewards, or revenue per token, then DCF-style thinking can sometimes be useful. But for many assets, valuation depends more on judgment, network data, and comparisons with similar projects. In that setting, precision is often an illusion. So it is better to think in ranges than exact price targets. You're asking whether the asset looks broadly expensive, reasonable, or cheap relative to what the network is doing. That makes crypto valuation less like a neat spreadsheet exercise and more like structured decision-making under uncertainty. Chain fault is a good example of why attractive signals and meaningful risks can exist at the same time. A public team and growing transactions are encouraging because they suggest some credibility and rising activity. A fixed supply may also sound favorable, but if only 30% of tokens are circulating, future unlocks could still create pressure on holders. Big performance claims should not be accepted at face value, especially without audits, technical proof, or a history of stable operation. Even a lower price-to-fees ratio than Ethereum would only be a clue, not a conclusion, because differences in adoption, security, and ecosystem strength still matter. So the verdict depends on testing multiple angles together, not on one appealing metric. The biggest mistakes in fundamental analysis usually come from treating surface signals as proof. Rising price is not evidence of quality, and a polished white paper is not the same as execution. Investors also get into trouble when they ignore dilution, future unlocks, or the possibility that competitors may capture adoption instead. One of the most important distinctions is that a good protocol is not always a good token investment, because value does not automatically flow to token holders. The core takeaway is to build an investment case around evidence, what supports value, how the token captures that value, and what could break the thesis. If you can answer those clearly, you're already thinking more like an investor than a speculator. Section 2. On-chain metrics. On-chain metrics come directly from the blockchain's public ledger, which makes them different from exchange data like price and trading volume. They show what is actually being recorded on the network itself, including transfers, wallet activity, and block production. That means they can reveal whether a network is active even when market sentiment is noisy or distorted. They can also show miner or validator participation, which adds useful context about support and security. For investors, this makes on-chain data a kind of reality check beside market prices. It does not tell the whole story, but it helps answer whether network activity is backing the narrative. Investors use on-chain data carefully because it is informative, but not magical. These metrics can help confirm a bullish story or warn that price is running ahead of real activity. For example, if a token is rallying while usage and participation are also rising, the trend may have stronger support. If price is surging while on-chain activity is weak or falling, that may suggest speculation is doing more of the work. Still, most on-chain data is backward-looking, since it records what has already happened. That is why it works best as one part of a broader framework that also includes fundamentals, competition, and risk management. Usage metrics try to answer a simple question: is this network actually being used? Active addresses are one starting point, because they track addresses that send or receive funds, but they are not the same thing as unique users. Transaction count adds another layer by showing how much confirmed activity is occurring, although spam or bots can inflate that number. Transaction value helps estimate how much economic value is moving, but even that can mislead if transfers are repetitive or low quality. The strength comes from combining these indicators rather than relying on one of them alone. When multiple usage metrics improve together over time, the case for real traction becomes much stronger. Security and participation metrics depend on the type of blockchain you are studying. In proof-of-work networks, hash rate is especially important because it reflects the computing power securing the chain. A higher and stable hash rate often suggests stronger resistance to attack and continued miner commitment. In proof-of-stake networks, the more relevant measure is often staking ratio, or the share of supply locked in staking. A high and stable staking ratio can signal that token holders and validators are committed to supporting the network. The key idea is that you should match the metric to the design, because proof of work and proof of stake do not express security in the same way. Some on-chain metrics connect valuation with actual network behavior. NVT, or network value to transactions, compares market capitalization with transaction value, so it gives a rough sense of whether valuation looks high or low relative to network activity. A high NVT can suggest that market value is running ahead of usage, while a lower NVT can suggest activity is stronger relative to valuation. MVIA adds a different perspective by tracking how long value-weighted coins remain unmoved. If MVIA rises, it can indicate coins are aging in place, while a sharp drop may signal that older coins have started moving again. Neither metric is a precise valuation model, but both can add useful context when paired with other indicators. A simple way to organize all this data is to group it into 3 investor questions. First, is the network being used, which leads you toward metrics like active addresses, transactions, and fees. Second, is the network secure and supported, which points you toward hash rate, staking, validators, and developer activity. Third, does valuation make sense relative to activity, which is where measures like NBT or fee-based comparisons become useful. Once you have those answers, compare them with the price trend rather than starting with price alone. This keeps analysis structured and reduces the temptation to chase whichever metric happens to look exciting that week. A repeatable process makes on-chain analysis far more useful. Begin by defining exactly what you are measuring, because there is a big difference between studying a base blockchain and studying a token contract on top of it. Then gather data from reliable sources such as block explorers and analytics platforms, and be ready to compare sources when numbers differ. Choose a set of usage, security, and valuation metrics that fit the network's design. After that, compare those trends with recent price action to look for confirmation or divergence. Repeating the same framework over time helps you build comparable observations instead of one-off opinions. One of the most useful questions in on-chain analysis is whether price and network activity are telling the same story. If price is rising and activity is rising too, that can indicate stronger support behind the move. If price is climbing while activity is weakening, the rally may be driven more by speculation than by improving fundamentals. Sometimes, the most interesting case is a flat price with improving on-chain data, because that can suggest traction is building before the market fully recognizes it. The opposite can also happen, where activity fades before price responds. In all cases, focus on trends across weeks or months rather than reacting to one-day moves. The Chain X example shows how on-chain analysis can highlight bullish divergence. Suppose active addresses rise from 50 none and 00 Sinnet, while the staking ratio climbs from 30 to 45%, yet the token price stays mostly unchanged. That would suggest stronger usage and deeper participation even without a visible price response. If MDIA is also rising steadily, it may indicate coins are aging rather than being dumped, and an NVT of 20 might look moderate rather than overheated in that context. Taken together, those signals could support a constructive view. Even so, you would still want to verify that address growth is genuine and that staking is not being inflated by temporary incentives. On-chain metrics are easy to misuse when context is ignored. Addresses are not the same as users, because one person can control many wallets and one wallet can represent many people. Transaction count also needs quality control, since a burst of low value or automated activity does not necessarily mean meaningful growth. NVT should not be treated like a stock PE ratio, because blockchains and companies generate value differently. Short-term spikes can also create false signals if you react too quickly. Healthy skepticism matters here. Ask what the metric really measures, what could distort it, and whether the trend is persistent. A practical way to build skill is to study one familiar asset over a short window and make yourself form a view. Collect 30 days of active addresses and transaction count, then add either hash rate or staking ratio depending on the network. Record or calculate NVT so you have at least one metric connecting value to activity. After that, compare the on-chain trend with the price trend and decide whether the overall picture looks bullish, bearish, or neutral. Keep the conclusion simple, but write down why you reached it. That habit turns raw data into a repeatable investment process. Section 3. Network effects. Network effects matter because some networks become more useful as more participants join them. In crypto, that can support long-term adoption by making a protocol more attractive to users, developers, liquidity providers, or counterparties over time. If a network reaches meaningful scale, those benefits can also influence durability and valuation. But this idea is often exaggerated in marketing, so investors should not accept network effect claims just because a project says them loudly. The real question is whether participation is actually making the network better in a measurable way. Evidence matters more than the story. User counts are only one piece of network value. A blockchain or protocol can also become stronger when developers build useful applications, when liquidity improves trading and execution, and when merchants or infrastructure providers make the network easier to use. In other words, the ecosystem around the network often matters as much as the headline number of users. A protocol with modest user growth but rising developer activity and better integrations may be improving more than it first appears. On the other hand, a network with a lot of wallets but weak tooling and shallow liquidity may not be very durable. Investors should look at the reinforcing groups around the system, not just one adoption metric. Direct network effects happen when each additional user makes the network more useful for existing users. Payment-like systems are the clearest example, because the more people who can send, receive, and accept the asset, the more valuable participation becomes. Bitcoin is often discussed this way, since more holders, wallets, exchanges, and merchants can reinforce its usefulness and visibility. That does not mean every additional user creates equal value, but it does mean growth can become self-reinforcing. The important thing for investors is to ask whether user growth directly improves utility for the rest of the network. If it does, the network may have a stronger foundation than one growing only through attention. Not all network effects are direct. Indirect effects appear when one group attracts another, such as users attracting developers, and developers creating better apps and tools that bring in more users. Ethereum is a familiar example because much of its growth has come from this broader ecosystem dynamic, rather than simple user-to-user interaction alone. Two-sided effects are slightly different. They involve two distinct groups that benefit each other. Like traders and liquidity providers on an exchange, more traders attract liquidity, and deeper liquidity improves execution, which attracts more traders. These structures can be powerful, but only if both sides are genuinely participating rather than being temporarily subsidized. Network effects usually develop in stages rather than appearing instantly. Early on, people join because the product offers clear utility, not because the network is already dominant. If that utility is real, growth can become self-reinforcing as more participants make the system more useful. Over time, complementary services such as wallets, analytics, payment tools, or apps may begin building around the network. Eventually, switching costs can rise and a moat can form, because leaving means giving up liquidity, integrations, familiarity, or counterparties. This is why bootstrap incentives may start adoption, but true network effects begin only when people keep joining because the network is already useful. A durable network is often hard to displace even when a rival offers better technology on paper. Liquidity is one reason, because users prefer markets where execution is easy and capital is already present. Tooling and integrations add another layer of stickiness, since developers and users gravitate towards systems that already work well with wallets, exchanges, and applications. Trust also matters, especially in finance, where counterparties, institutions, and long operating history can create an advantage. That is why the technically best product does not always win. For investors, durability depends not just on features, but on how deeply the network is embedded in real behavior. When a project claims strong network effects, look for evidence across several dimensions. Start with user activity, but focus on meaningful and repeated use rather than just address counts. Then examine developer participation over time, because networks with real momentum often keep attracting builders. Liquidity depth matters too, especially if it remains healthy without heavy rewards or temporary subsidies. One of the best tests is persistence after incentives fade. If usage, liquidity, and activity remain stable, the growth is more likely to be durable. Real network effects tend to leave a broad footprint, not a single flashy metric. A decentralized lending protocol is a good example of network effects building through multiple groups. At very small scale, terms may be weak because liquidity is thin, borrowing options are limited, and liquidations may be less reliable. As more lenders enter, borrowers get better access to capital, and as more borrowers use the system, lenders may earn better returns from a more active market. That creates a reinforcing loop where each side helps the other. If outside tools such as dashboards, alerts, insurance, or DeFi integrations also appear, the protocol becomes even more useful. In this case, network effects come not just from size, but from better market functioning and stronger ecosystem support. Network effect stories are weak when growth is shallow, temporary, or unsupported by real usage. A large wallet count can mislead if many wallets are inactive, duplicated, or created just for incentives. Liquidity can also look impressive during reward programs and then disappear once subsidies end. Being early is not enough either, because first mover advantage fades if execution weakens or users find better alternatives. And in crypto, growth can even create negative effects when congestion and high fees make the network less usable. A real network effect should improve the experience as adoption grows, not make the system worse. A practical checklist can help separate narrative from evidence. First, identify the main user groups involved, such as traders, developers, validators, borrowers, or liquidity providers. Then, classify the dominant network effect. Is it mainly direct, liquidity-driven, developer-driven, or something else? After that, choose one measurable indicator that would show real strength, like daily active users, monthly developers, or sustained TBL growth. Finally, name one risk that could break the effect, such as fee spikes, a hack, regulation, or user migration. This keeps your analysis grounded, because a strong story is not the same thing as a strong network. Section 4. Adoption curves. Adoption curves matter because they help investors think about how a crypto network grows over time, rather than judging it from a single snapshot. As more users join, network utility often improves, and that can attract developers, applications, and other forms of support. When this process works well, network effects can strengthen as the system scales. Adoption can also affect value and security, since more activity may mean more fee generation, stronger participation, or deeper liquidity. For investors, the point is not just to count users, but to understand where growth is coming from and what it might lead to. The curve gives context to the network's stage of development. A common pattern for adoption is the S-curve. Growth tends to begin slowly because early users are few. The product may still be rough, and trust has not been built yet. If the network reaches a tipping point, adoption can accelerate quickly as awareness, utility, and network effects reinforce each other. Later, growth often becomes harder to sustain as the market matures and the easiest gains have already been captured. That is why the curve eventually flattens. It is a helpful pattern, but not a rule, especially in crypto where adoption can be much more uneven and volatile. Crypto adoption tends to be more volatile than traditional product adoption because the conditions around it can change very quickly. Exchange listings, major app launches, or a favorable market cycle can produce sudden surges in users and activity. Protocol upgrades can also improve performance and accelerate growth, but the reverse is equally common. High fees, congestion, hacks, or a poor user experience can slow adoption just as fast. Regulation and new competition can also reverse momentum. So while crypto networks can grow rapidly, investors should remember that bursts of adoption are not always durable. Who adopts first in crypto often tells you a lot about what the current activity really means. Early users are frequently developers, traders, or speculators rather than mainstream consumers. That can create sharp increases in usage metrics before the network has proven broad practical value. Later users usually care more about convenience, cost, speed, and useful applications than about the technology itself. As adoption broadens, the user mix changes, and that shift can be more important than the raw growth number. In other words, early activity is not the same thing as mass market demand. The investing question is not only whether adoption is growing, but where the network sits on its adoption curve. In the early stage, upside may be high, but uncertainty is also highest because product market fit and durability are still unclear. Mid-curve networks usually show stronger traction, though the easiest gains may already be behind them. Late-stage networks are more established and often more resilient, but growth tends to slow. Plateau or decline phases require extra care, because stagnation can persist unless a new catalyst restarts the curve. Position on the curve shapes expectations, risk, and valuation. No single metric captures adoption well enough on its own. Active addresses can help, but they should be read alongside transaction count, transaction volume, developer activity, fee revenue, and wallet growth. Together, these indicators can show whether momentum is broadening, leveling off, or fading. For example, rising transactions with stable developer activity and growing fees may suggest healthier adoption than rising addresses alone. You also want to judge the quality of activity, because temporary incentives or low-value usage can distort the picture. A basket of indicators gives a much more reliable read than one headline number. Inflection points often matter more than the absolute level of usage, because they show when the direction of adoption is changing. A catalyst such as better user experience, lower fees, or wider access can trigger compounding growth. Congestion or poor performance can weaken the experience and flatten the curve. Competition may also cap expansion by splitting users across alternatives. On the positive side, a successful upgrade can restart a stalled network and create a new phase of growth. For investors, the key is to watch where momentum turns, not just where the network happens to stand today. Ethereum is a strong example of adoption moving in waves rather than along one smooth curve. In 2015, growth was relatively slow and concentrated among developers experimenting with the platform. In 2017, the ICO boom sharply accelerated activity and brought much broader attention. Then, in 2020 and 2021, DeFi and NFTs created another major surge, while also exposing limits such as congestion and high fees. More recently, growth in Layer 2 networks has renewed adoption within the broader Ethereum ecosystem rather than only on the base chain. The lesson is that adoption can pause, surge, and shift form over time without following a neat pattern. Adoption curves are useful, but they can mislead when applied too mechanically. Growth is rarely linear, so a smooth model should not make you expect a smooth reality. Price is also not the same as usage, because speculative markets can detach from actual adoption for long periods. Another common mistake is ignoring churn or low-quality activity, such as bots, airdrop farming, or one-time bursts that do not stick. And the model itself is not a forecast. It helps organize history and current evidence, but it does not guarantee what happens next. A practical exercise is to choose a network with at least a year of history and try to classify its current adoption phase. Track one or two metrics that seem most relevant, such as active addresses, fees, or developer activity. Then review those trends in 6-month intervals so you can see whether momentum is accelerating, stabilizing, or fading. Based on that evidence, decide whether the network appears to be early, growing, mature, or slowing down. The important part is to support your answer with actual data rather than intuition alone. That turns the adoption curve idea into a working investment habit. Section 5. Valuation Approaches. Crypto valuation starts with a basic question that is easy to skip. What does the token actually do? Stocks are often valued around earnings, cash flows, dividends, or buybacks, but many crypto tokens do not pass value to holders in those ways. Some tokens do connect to fees, staking rewards, or other economic benefits, which makes them more suitable for cash flow style analysis. Others depend more on usage, demand for access, or even narrative strength. Because these designs vary so much, there is no single valuation formula that works across all tokens. The right starting point is function, not habit. One of the cleanest distinctions in crypto valuation is between productive and non-productive assets. Productive tokens have some link to fees, revenue, staking income, or another economic output that may matter to holders. Non-productive tokens do not directly generate holder cash flows and are often valued more through adoption, utility, or relative metrics. Payment coins and many utility tokens fall into that second group. This does not mean productive assets are automatically easy to value, or that non-productive assets have no value. It simply means the asset type should determine the valuation method you use. Traditional finance metrics can be helpful in crypto, but only when they truly fit the token's economics. A PE-style approach makes sense only if the token has something close to earnings that belong, directly or indirectly, to holders. DCF can work when future cash flows are identifiable and token holders have a credible claim on them. Otherwise, crypto-native measures may be more informative. NVT is often closer to a blockchain version of price to sales, while utility-based analysis focuses on what drives demand for the token itself. The danger is false confidence from using a familiar metric on the wrong type of asset. NVT, or network value to transactions, compares a network's market cap with its daily on-chain transaction volume in dollar terms. In simple terms, it asks how much value the market is assigning to the network relative to how much value appears to be moving through it. A higher NVT can mean valuation is rich compared with activity, while a lower NVT can mean activity is stronger relative to valuation. The metric is useful, but noisy, so it is usually better to use average transaction volume over time rather than a single day. It also works best as a relative indicator, not as a precise model of fair value. Think of it as a clue about whether valuation and usage are in balance. NVT is only one relative measure, and many tokens need more context than that alone can provide. For Bitcoin, some investors look at the Meyer multiple, which compares price with the 200-day average to judge whether price is relatively stretched or depressed versus trend. A reading below 1 has sometimes been viewed as relatively cheap, though it is only a support tool, not a buy signal. Utility analysis adds a different lens by asking what actually creates token demand. Gas usage, staking lockups, and required use within applications can all matter. The broader lesson is that non-cash flow tokens should be judged through multiple demand and relative value checks, not a single ratio. DCF can be useful for productive tokens when a protocol generates fees or other economic value that may reach token holders. The process starts by estimating future revenue or fee streams, usually under several scenarios rather than a single forecast. Then you apply a risk-adjusted discount rate, which should usually be high because crypto cash flows are uncertain, competition is intense, and token designs can change. That converts future value into present value. After that, you translate the total value into a per-token estimate based on circulating supply or another defensible token count. The method only works if token holders have a real economic claim, but when they do, DCF can provide a disciplined anchor. A simple DCF example shows both the usefulness and the fragility of the method. Suppose a protocol generates $20 million in annual fees, and after modeling future growth and discounting risk, you estimate the present value of future fees at $50 million. If there are 10 million tokens outstanding, that implies a value of about $5 per token. If the market price is $2, the token may look undervalued relative to your model. But that conclusion depends entirely on the assumptions behind the fee stream, token holder rights, dilution, and discount rate. So the model does not give you truth. It gives you a structured estimate under stated assumptions. Relative valuation becomes more useful when you compare a network both with peers and with its own history. Suppose a network has a market cap of $30 billion and a 30-day average daily on-chain volume of $600 million. That gives an NVT of 50. If a similar peer trades at an NVT of 100, the first network may look less expensive relative to activity. But that is only a starting point, because differences in brand strength, off-chain use, user behavior, or low-quality volume can all affect the comparison. A lower NVT can be a clue, not proof of undervaluation. A sound valuation process is about building a defensible view, not producing one perfect number. Start by choosing a method that fits the token design, because valuation quality depends heavily on using the right lens. Then pull data from more than one source, so you are not relying on a single possibly distorted dataset. Compare your result with the asset's own history and with peers to add context. Cross-check your first conclusion with a second valuation method whenever possible. And most importantly, write down the key assumptions, because valuation becomes far more useful when you can revisit and challenge your own reasoning later. Crypto valuation has hard limits, and most mistakes come from forgetting that estimates are not facts. Market cap is not the same as fundamental value, and the same model should not be applied blindly across very different token designs. On-chain volume can also be distorted, low quality, or partly irrelevant if meaningful activity happens elsewhere. Token velocity matters because fast turnover can weaken value capture, and future dilution matters because new issuance can reduce per token value even if the protocol grows. That is why valuation should usually be expressed as a range of possibilities. The goal is not precision, but a more disciplined understanding of what would need to be true for the asset to be attractive.